the credit union broadcast experiences. Cube TV.
Hello, I'm Sean Wolber.
And I'm Gloria Ledoux.
Bringing you the 2014 Year in Review Compliance Update at the CU Compliance Connection by InfoSite, only on Cube TV.
This presentation provides information on the compliance issues your credit union has worked on and probably continues to work on as 2014 comes to an end.
In the first quarter of 2014, credit unions had to comply with the final NCUA rules for liquidation and contingency funding, and also the availability of interest rate derivatives for federal credit unions. From the CFPB, the majority of the mortgage rules became effective, such as the ability to repay, qualified mortgages, loan originator compensation, valuations and appraisals, HOEPA requirements for high-cost mortgages, and mortgage servicing rules. Felt like I was going to go on forever.
There were a lot. We will also talk about NCUA rules for credit union service organizations, or CUSOs, and the capital planning and stress testing rules that became effective in the second quarter of 2014.
The third quarter of 2014 brought us the first rules from the IRS related to the Foreign Account Tax Compliance Act, or FACTA, and the final rules for voluntary liquidations from the NCUA.
And it doesn't appear the fourth quarter was any lighter. In fact, the CFPB finalized 3 rules. The first related to the annual privacy notice requirements, the second related to international remittance transfers, your favorite, and the third a qualified mortgage cure provision. FASB also finalized a rule related to the accounting treatment of goodwill.
And before you get excited about the changes as far as the Privacy Act goes, they weren't what we had hoped for.
Unfortunately not. So let's get started on our 2014 year in review.
Effective on March 31st, 2014, federally insured credit unions needed to comply with the NCUA's 3-tiered framework for liquidity and contingency funding plans. The first tier for credit unions under 50 million, the SAS credit union size, must maintain a basic written liquidity policy with board-approved framework for managing liquidity, and they have to have a list of contingent liquidity sources that could be utilized if it was needed. The second tier for credit unions over 50 million in assets needs to have that same written liquidity policy, but they must also have a contingency funding plan that clearly sets out the strategies for addressing liquidity needs in an emergency. The third tier for credit unions over 250 million in assets needs to have the same policy as the second tier, but they also need to establish at least one contingent federal liquidity source. And that either has to be the discount window with the Federal Reserve or the central liquidity facility. Now they have those 2 options. There are benefits associated with each. So credit unions need to really look at that and make a determination as to which way they want to go.
And the regulation did state that the Federal Home Loan Bank is not a source.
Yes, that's true.
The NCUA finalized a rule that became effective on March 3rd of this year that allowed federal credit unions to utilize interest rate derivatives in order to mitigate interest rate risk. Federal credit unions interested in purchasing derivatives will need to apply to the NCUA for authority. This is done in a 2-stage process, with the first stage being more limited authority. The new derivative authority allows for the purchase of interest rate swaps, caps and floors, basis swaps, and Treasury futures. Moving right along to the CFPB rules, which is going to take us a good 15 minutes to get through, we'll start with the ability to repay rule, which covers your closed-end loans secured by a dwelling, first or second lien, and not limited to primary residence, and requires that you as a credit union are making a reasonable good faith determination that your member has the ability to repay the loan. Credit unions should be evaluating and documenting their compliance with the required 8 underwriting factors in the regulation.
And Gloria, I have to say, credit unions, I believe, really are doing this.
Yes.
It's the documentation piece that they haven't always had in the background.
Yes, so make sure your policies and your procedures indicate that you are reviewing those 8 underwriting factors. Those credit unions that underwrite qualified mortgages, or QMs, are provided with a presumption of compliance with the ATR requirements, or a safe harbor from liability. There are 4 types of qualified mortgage categories. The general qualified mortgage category has the debt-to-income ratio of no more than 43%. So loans that have a debt-to-income ratio above this percentage will not be considered qualified under this particular category. For a loan to be qualified under the temporary qualified mortgage category, it must be eligible for purchase or guarantee by a GSE, which is Fannie or Freddie, which can be established by a valid recommendation from a GSE automated underwriting system. So for small credit unions, and those are with assets below the $2 billion at the end of the calendar year, and those that have originated no more than 500 first lien closed-end covered transactions in the preceding calendar year with their affiliates, are eligible for the 2 qualified mortgage categories we just went over and 2 additional qualified mortgage categories. So the small creditor qualified mortgage requires that you not exceed certain points and fees thresholds and consider debt to income or residual income, but there is no specific threshold. So no 43% requirement for the small creditor qualified mortgage. Lastly, there's a balloon payment qualified mortgage for small creditors, which will be available until after 2016 for all small creditors. After that, as far as we are aware, it will only be for credit unions servicing rural or underserved areas. Again, there are certain requirements credit unions need to comply with to obtain this QM status, but there's no specific debt to income requirements or threshold. The CFPB also just finalized a post-consummation cure mechanism for loans that exceed the points and fees threshold to be a qualified mortgage. We're going to talk about that when we review what became effective in the 4th quarter of this year.
Yep, and Gloria, when we look at this, the risk to a credit union really is the liability that if in the future the credit union doesn't follow the qualified mortgage and ability to repay rules, a member who defaults on their loan could literally go back to the credit union, file a lawsuit, and it's on the credit union to really determine whether or not they've met those standards, or they could lose their note position and mortgage position.
Yes, so it's very important that credit unions who have determined to offer mortgages that are not qualified under the rule understand that there may be a risk that they're going to have to defend in court that that member did have the ability to repay that mortgage. So if your credit union made the determination to offer non-qualified mortgages, make sure you're documenting your compliance with the 8 underwriting factors and can prove that in a court of law.
Yeah, great advice. So for the CFPB loan originator compensation, which is the next CFPB rule we're going to discuss, the mortgage loan originator, or the MLO, cannot receive compensation on any of the mortgage loan's terms or conditions. There's also a prohibition on dual compensation. So if the MLO receives compensation from the borrower in connection with that mortgage loan, they cannot receive compensation from their credit union or another organization or person for that same transaction. Additionally, the rule makes slight changes to the SAFE Act, requirements for MLOs who must be registered according to the SAFE Act. So for MLOs and credit unions, let me state that again, MLOs and credit unions must include their name and NMLS ID on the following loan documents: the credit application, the note or loan contract, and the security instrument. Generally, you should include that information on documents that require your member's signature.
So the CFPB also had rule changes for valuations and appraisal requirements. So the valuation and appraisal rules amended both TILA, which is Truth in Lending, and ECOA, the Equal Credit Opportunity Act. So the amendments to TILA apply to your high-priced mortgage loans. So those are going to be your first lien closed-end loans with an APR above the APOR by more than 1.5%, 2.5% for jumbo loans in first position, or 3.5% for your subordinated liens. For those high-priced mortgage loans, the credit union is required to provide a disclosure to the member within 3 days of receiving an application that they're entitled to a free copy of their appraisal. This requirement is also a part of the ECOA requirements. Credit unions can find the required language within the regulation and are encouraged to use that for a safe harbor. So anytime that the regulation is providing you with language and saying if you use this, you're going to be compliant, We would encourage you to use that language. For your high-priced mortgage loans, you will also be required to obtain a written appraisal from a certified or licensed appraiser and provide a copy of that appraisal to the applicant no later than 3 business days before consummation. There are a few exemptions to this rule, so reference the Small Entity Compliance Guide or the regulation for further detail. The ECOA rule applies to open and closed-end loans secured by a dwelling, but only those loans in first lien position. So consistent with the TILA rule, credit unions are required to disclose the right of the member to receive a copy of appraisal and/or valuations within 3 business days of receiving the member's application. Additionally, credit unions will be required to share copies of appraisals or other written valuations promptly with the applicant.
And now we're going to look at the HOEPA rule, or the High Cost Mortgage and Credit Counseling Rule, which makes a very significant change to the treatment of high-cost mortgages. The HOEPA rules apply to consumer credit transactions secured by a principal dwelling, and this includes purchase money mortgages, refinances, closed-end home equity loans. Now, all that is the same as it has been in the past, and here, you ready for the change? Open-end credit plans, which would include your HELOC loans. That's new. We're pointing out the coverage of the HELOCs in the new HOEPA requirements to ensure that credit unions understand this change. High-cost mortgages require special disclosures that must be provided to members 3 days before consummation or account opening. The HOEPA rules apply to consumer credit transactions secured by a principal dwelling. That would include purchase money mortgages, refinances, closed-end home equity loans, and wait for it, open-end credit plans, so your HELOC loans. Now, this is a significant change because HELOCs have not been included in this definition before this rule change by the CFPB. We're pointing out the coverage of HELOCs in the new HOEPA requirements to ensure that credit unions understand this change. High-cost mortgages require special disclosures that must be provided to members 3 days before consummation or account opening. The disclosure should state that the loan will not be effective until consummation or account opening occurs. It has to explain the consequences of default. It has to disclose the terms such as the APR, the amount borrowed, and the monthly payment. And if it's a variable rate mortgage, explain the maximum monthly payment that may be required that the member pay. The rule bans certain loan features for high-cost mortgages, and this includes prepayment penalties, due-on-demand features, and, most upsettingly, balloon payments, except in certain circumstances. And those circumstances are things that the credit union services a predominantly rural or underserved area and meets the ATM or qualified mortgage rule requirements.
Correct.
The rule also contains a requirement that members receiving a high-cost mortgage must have HUD counseling before closing the mortgage loan. This can be difficult because the counseling certificate required for closing the loan cannot be issued until the counselor has verified that the member has received all of the high-cost mortgage disclosures, including their settlement statement. So what that means for your members is that they're actually going through a 2-step counseling program. They get counseled on the initial disclosures that they've received, and then get an additional follow-up counseling after they've received their settlement statements before close, have to receive the certificate of counseling, and then provide that to the credit union before the loan can close.
Right.
A very difficult timing piece that we've had to put into place. Credit unions are also required to provide a list of home ownership counseling organizations to members applying for a mortgage loan within 3 business days after application. This includes first and subordinate liens on residential real property designed for 1 to 4 families, with the exclusion, and it's a very small exclusion, of reverse mortgages and mortgage loans secured by a timeshare.
There are a significant amount of requirements for credit unions to comply with related to mortgage servicing. The new rules amended both RESPA and TILA. The RESPA revisions require credit unions to comply with regulation changes related to error resolution and information requests, forced place insurance, general servicing policies, procedures and requirements, early intervention with delinquent members, continuity of contact with delinquent members, and loss mitigation. These rules are going to apply to your closed-end consumer loans secured by a dwelling. The mortgage servicing rules also amended TILA and made changes to the interest rate adjustment notices for adjustable rate mortgages, established requirements for the prompt crediting of payments and responses to requests for payoff amounts, and established periodic statement requirements for closed-end mortgage loans. Credit unions that are considered a small servicer, which would be credit unions that together with their affiliates service 5,000 or fewer mortgage loans, and the credit union or their affiliate is the creditor or assignee for all of them. If your credit union qualifies as a small servicer, you are exempt from certain mortgage servicing requirements. However, you are still required to comply with the armed disclosure provisions, prompt crediting and payoff statement provisions, and certain of the force-placed insurance provisions, error resolution and information requests, and some of the loss mitigation provisions. So there's certain things that will apply to you as a small servicer and certain things that do not. Again, because there's so many components to the servicing rules, we are encouraging credit unions to review the CFPB's Small Entity Guide and/or the relevant regulation for further details on the requirements under each rule. Additionally, the CFPB is also proposing amendments to these rules, so credit unions should be aware of what the proposed changes are, again, and how it may impact their credit union.
That's standard for the CFPB, is creating the rules, pushing them out, and then amending them. Was that only the first quarter? It's no wonder credit unions need regulatory relief. Moving right along, let's go over our second quarter final rules. Now we'll review the NCUA capital planning and stress testing. This regulation was finalized at the April 2014 NCUA board meeting. There are only a handful of covered credit unions under the rule, those credit unions that exceed the $10 billion in asset threshold as of March 31st of the current calendar year. In addition to the requirement of a capital policy, which has required components listed in the regulation, the covered credit union is required to develop a capital plan, which is submitted annually to the NCUA. Additionally, this rule also provides for the NCUA to have the authority to annually assess the adequacy of the covered credit union's capital plan. The results may require credit unions to enhance their capital and/or take other supervisory action against the credit union.
Effective in June 2014, CUSOs, or credit union service organizations, were required to provide basic profile information to the NCUA and relevant state authority. Certain CUSOs that are considered complex, which are those performing what the NCUA deems to be high-risk activities, such as credit lending and information technology, will be required to report more detailed information, including audited financial statements and customer information. These CUSO requirements also apply to state-chartered credit unions with subsidiary CUSOs. Credit unions should review NCUA Letter 13, CU 13, to determine if written agreements between the credit union and the CUSO need to be amended to comply with the new requirements under the rule. So that's typically your contract revisions that need to take place there. Worth mentioning is also the NCUA legal opinion letter that actually clarified that the CUSO rule only covers those credit unions investing in or lending to a CUSO to obtain that written agreement, typically through the contract revision. That requires the CUSO to submit annual reports in accordance with the rule, so that needs to be spelled out within the contract. Credit unions that only have a service contract with a CUSO do not need to adhere to the same written requirements. Well, the second quarter was a little bit better than the first quarter, so let's review what we had in store during the third quarter of 2014.
So the IRS revisions to the FACTA, or Foreign Account Tax Compliance Act, are intended to target the illicit activities of individuals who use offshore accounts to evade taxes. Many of the revisions apply to foreign financial institutions, or FFIs, which would not be a credit union. However, the requirements to withhold for certain payments made to FFIs begins on July 1st, 2014. The IRS continues to publish instructions on these FACTA revisions, and credit unions are encouraged to contact their tax advisors to make sure that you're correctly reporting on the 1042 forms and have proper procedures in place for your W-8 bend forms, because there are new compliance requirements such as having certain standards of knowledge regarding the accuracy of the form. Being a transition period for 2014 and 2015, the IRS will take into account the extent to which the withholding agent has made a good faith effort to comply. Now, credit unions already use the W-8 BEN in the most part, so really make sure that you're using it correctly, that you have the policies and procedures in place to do the correct reporting and follow up with the members.
Now let's talk about the NCUA voluntary liquidations. The amendments to the rules apply to federal credit unions only who are voluntarily liquidating their credit union. The amendments will allow those federal credit unions to publish any required creditor notices in electronic media and will allow those federal credit unions to also share payouts to members by electronic payment methods. They did not have this option before. The NCUA also revised the small asset threshold up to $50 million to be consistent across the NCUA rules. And that's going to impact the frequency of notice publication requirements. The NCUA also clarified that for the purposes of the pro rata calculation for distribution to the members, the credit union will use the date the members approved the liquidation to compute those share balances.
Last but certainly not least, let's explore what credit unions are dealing with in the final quarter of 2014.
Well, the long-awaited changes to Regulation P and the annual privacy notice requirements became effective at the end of October. Although we were really hoping for a little more regulatory relief with this rule, we're hoping that it will provide some credit unions with relief, and we're just going to have to take what we can get at this time. The amendment creates an alternative delivery method for the annual privacy disclosure, which can be used by the credit union only if certain conditions are met. So they have contingencies here. First, the credit union would be required to post their privacy notice on their website in a clear and conspicuous manner and on a page, so a web page, that only the contents of the model policy can be accessed without any type of login name or additional steps. So your members and your non-members equally should have access to this page from your website. The credit union then has to notify the membership at least annually via an account statement, coupon book, or any other type of disclosure that's required by law that their privacy notice is on the website and it can be mailed to those who request it by phone and that no changes have been made.
Now, Gloria, I'd like to state here that we've had a lot of questions that have come into both of us about whether or not they can put this required annual notice in their credit union newsletter. And the answer to that question is no.
No. It has to be in some sort of publication that's required by law, which is why they say the coupon book or the statement.
Yep.
The additional conditions that the credit union must meet in order to use this alternative delivery method are listed on the slide for you.
As if there hasn't been enough revisions to Regulation E, my favorite, and the requirements for international remittance transfer, and you can look at many different presentations we have done on that are stored on Cube TV. The most recent amendments the CFPB did was to extend an exception that allows credit unions to estimate certain disclosures when exact information cannot be determined for the reasons beyond their control. Now, this exception has been extended to July 2020, and the reason for that is simply we have no way to get the information they require in the regulation. So, going forward, we're going to have to find out if there's a way that we can gather the data or if there's some way that this can be created so that they don't have to continue extending this out. But at this time, both the government and credit unions and financial institutions understand that what is being asked for in the regulation is just unable to be provided. Additionally, clarification also included that U.S. military installations abroad are considered to be located in the states for the purposes of the rule. Therefore, transfers to individuals and accounts located on U.S. military installations located abroad, as well as from individuals and their accounts located on U.S. military installations abroad to recipients here in the U.S., are excluded from the remittance transfer rules. And this just goes along with protecting our service members and providing them with the services that they need. There was also some clarifying commentary that was included in the amendments related to the purpose of the account for determining coverage and for the requirement for satisfying the provisions that disclosures are provided in writing.
As I briefly mentioned earlier, the CFPB has amended Regulation Z to allow for a post-consummation cure provision for loans that exceed the points and fees limit for a qualified mortgage. So the safe harbor provisions of the regulation will still apply even if those points and fees were exceeded. The credit union now has the ability to refund those points and fees that exceeded that applicable qualified mortgage limit at the time of consummation with interest, so that the mortgage can be considered a qualified mortgage and maintain that safe harbor. There are certain criteria that the loan must meet and certain policies and procedures that the credit union must have in place in order to utilize this cure provision.
FASB also made some amendments that allow for an accounting alternative for the subsequent measure of goodwill. Now, goodwill is that residual asset recognized in a business combination after recognizing all other identifiable assets acquired and liabilities assumed. According to FASB, credit unions can now amortize goodwill on a straight line basis over 10 years, or less than 10 years if they can demonstrate another useful life is more appropriate. There are also testing requirements when a triggering event occurs that indicates the fair value of an entity may be below its carrying amount. Credit unions should review the FASB amendments with their accounting department to see if any revisions to goodwill measurements should be made.
Thank you for joining me and Sean at the CU Compliance Connection, and stay tuned for future broadcasts on issues that affect your credit union.
We are here to help you at the CU Compliance Connection by InfoSite, only on Cube TV.
Cube TV is powered by CU Solutions Group. Stay tuned.